Welcome to Endonormal BCTA support course for 2020. My name is Zamantungwa Kumalo and I'll be taking you through the course throughout the semester. In the previous lecture, we covered income taxes part 1, and in today's lecture, we'll be covering income taxes part 2, where we will primarily build on our knowledge from the first lecture as well as cover a range of new concepts. We will be looking at assessed losses, measurement, presentation and disclosure, tax rate reconciliation, CGT items, provisional tax, foreign income, rate change, dividend tax, as well as disclosure application. Now, I know it does seem like it's a lot and it's a bit overwhelming, but we will break down the principles, we'll break down the concepts to its simplest form to ensure that we understand the underlying principle as well as how it ties in with what we've already learned in the first lesson. So, the key objectives of today's lecture are to apply the principles relating to the measurement and recognition of taxes, as well as to prepare disclosure relating to the income taxes. And the key focus of the lecture, as I've already mentioned, we're going to look at deferred tax asset limitations, the measurement thereof, presentation and disclosure, capital gain taxes on companies, provisional taxes, foreign taxes, substantive enacted tax rates and tax laws, as well as dividend tax and withholding tax. And we'll also have a look, that was a lot of tax. And we'll also have a look at the examination technique, which will obviously be very beneficial and vital for you in performing well in your tests and exams. Okay, so we're going to do a quick recap of our deferred tax asset, and this really is just a refresher from what we covered in the first lecture. So remember, when we looked at deferred tax assets and deferred tax liabilities, we had 4 rules. 2 that were covering how we land at a deferred tax asset, and the other 2 was rule number 3 and 4 that sort of governed how we landed at a deferred tax liability. So we said that deferred tax asset is recognized if the following situation occurs. The carrying amount of the liability is greater than the tax base, then we will land at a deferred tax asset. Also, when the carrying amount of the asset is less than the tax base, then we will also arrive at a deferred tax asset. And remember, deferred tax assets are the amounts of income taxes recoverable in future periods in respect of deductible temporary differences, the carry forward of unused tax losses, as well as the carry forward of unused tax credits. So going forward, and as we cover more content, we will unpack what we mean by unused tax losses as well as unused tax credits. So relax, don't panic. So deferred tax assets should be recognized for all deductible temporary differences to the extent that it is probable that taxable profit will be available against which the unused tax losses can be utilized. Okay, that's a mouthful. So let's go back and let's unpack it and let's try and understand what they mean. So they're saying we have a deferred tax asset, and this so we've done our calculations using our balance sheet method and we land at a deferred tax asset. But we're also saying that that deferred tax asset should only be recognized. So we should only recognize it for all deductible temporary differences only to the extent that it is probable that taxable profit will be available against which the unused tax losses can be utilized. So basically what we're saying is that the company needs to do an assessment to say this year we've landed a deferred tax asset for our deductible temporary difference, but do we foresee in future that as a company we will be making sufficient profits in order for us to apply this asset against those unused tax losses. So basically it's a projection that the company needs to make. They need to decide, or they need to sort of make an estimate to say, are we going to have sufficient profits in future in order for us to recognize this deferred tax asset in the current year, because it generally does not make sense for them to have a deferred tax asset sitting on their balance sheet, but then they don't foresee themselves making any taxable profits in the future against which they'll be able to utilize this asset. But we'll unpack the concept and the detail of it as we do an example in the slides to follow. So, some more theory on deferred tax assets. The economic benefits in the form of reductions in tax payments will flow to the entity only if it earns sufficient taxable income against which the deductions can be offset. So the economic benefit of a deferred tax asset is that when the company starts making taxable profits or has taxable income in the future, this deferred tax asset can be utilized to sort of offset the tax that they would pay. So the economic benefit is now that in future, because they hold this deferred tax asset, the company is in essence going to pay less tax. Okay, so therefore the entity recognizes deferred tax assets only when it is probable that taxable income will be available against which the deductible temporary differences can be applied. So again, it goes back to the concept of we're raising this tax asset and we're only raising it because we know that in future it is probable that we will have sufficient taxable income against which we can utilize this asset to reduce the amount of tax that we're going to pay in future. So, it is probable that taxable income will be available against which a deductible temporary difference can be utilized when there are sufficient taxable temporary differences. Okay. So in such circumstances, the deferred tax asset is recognized in the period in which the deductible temporary differences arise. So when the above mentioned circumstances are present and there's a reasonable probability, a reasonable expectation that the company will have sufficient taxable income, then we will raise the deferred tax asset in the same period in which we derive those deductible temporary differences. Okay, so we'll do a first example, and this example has been adopted from the UNISA study guide. So if you have access to that study guide, please go and do a bit more similar examples. Okay, let's see what they say here. The company incorporated in the previous year, it has been paying the bonus to the directors since its incorporation, and the financial director at year end recognized the provision for bonuses amounting I just want to pull out my pen, sorry. Okay, my technology keeps giving me issues. So the company incorporated in the previous year, it has been paying the bonus to directors since incorporation, and the financial director at year end recognized the provision for bonuses amounting to 500,000 Rand because the company has a constructive obligation as a result of history of paying the bonuses regularly. Okay, so now this obligation has now come about as a result of past trends, history. The company's always been paying their bonuses, so now in the current year we're saying, okay, this has been done before, so we have a reasonable expectation to believe that it will also be done in the current year. The South African Revenue Services, SARS, will allow the provision for bonuses as a deduction as they actually incurred, and the tax rate is at 28%. And with the budget speech that was recently delivered this week, we do know that the tax rate has remained consistent and unchanged at 28%. So I also do encourage you guys to read the summary relating to the budget speech. I do encourage you to familiarize yourself with what's happening around you in politics and how that actually affects the economy and how that eventually filters down to the coursework that you do. And you'll see some of that when we do the substantive and the enactment of tax laws later on, how all of that actually filters into your coursework. Side note, okay. So deferred tax is provided for all temporary differences using the statement of financial position. So that's basically the balance sheet approach that we covered in the first lecture, for us to determine whether we have a deferred tax asset or a deferred tax liability. So there's no assurance beyond the reasonable doubt that there will be sufficient taxable profit in the future to realize any tax benefits. Ding, 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 ding. That's already a trigger. We just covered the instances when a company can actually recognize this deferred tax asset. And in this scenario here, they're actually specifically telling us that there is no assurance beyond the reasonable doubt that there will be sufficient taxable profit in future to realize any tax benefit. Okay, so let's see what they require us to do. So they require us to calculate the deferred tax asset year end using the statement of financial approach, which is our balance sheet approach. Okay, first things first, the exam technique that we covered towards the end of the previous lecture, draw your table. When you're using the balance sheet approach, always draw your table. It really provides clear perspective, and it just makes your chain of thoughts a lot easier to follow. So we go back to our information. We have our item, which is our provision for bonuses. We have our carrying amount, which has been stated to be 500,000 Rand. That is our accounting carrying amount, because that is the provision that we are going to raise on the basis that we have a constructive obligation due to past trends. So if you actually apply what would have been covered by Charity when we did the conceptual framework, you'd be able to land as to why this provision can be actually recognized as a liability, and and so forth. And then we have a tax base of 0. We have our tax base of 0 because we're saying that SARS is actually going to allow this provision as a deduction, as it is actually being incurred. So we're going to have a 0 tax base because there's nothing that SARS is going to deduct in future, because they're saying we're going to allow it. We're going to allow it currently. And then we're going to have a temporary difference, because remember, we do a quick calculation of our carrying amount. I really wish my pen could work. I really want to text here. I really want to use the text. Let's see. Okay, draw annotation. Okay, so then we do a quick calculation where we say your carrying amount minus your temporary difference, and then we arrive here. So remember when we did our summary, when we did our quick recap, where we said that where the carrying amount of the liability, in this case the provision, the carrying amount of the liability is greater than the tax base, then we're going to land at having a deferred tax asset. So let's go back. I just want us to go back to our rules where we said where the carrying amount of the liability, yes, which was 500,000, is greater than our tax base, which was sitting at 0, then we are going to land at a deferred tax asset. And we can see that coming through here. So even though we have a temporary difference of 500,000 Rand, so if you see, even though we have a temporary difference of 500,000 Rand on which we could actually be multiplying by 28% to get to our deferred tax asset, but because of this statement here, but because of this very important statement here that says there is no assurance beyond the reasonable doubt that there will be sufficient taxable profit in the future to realize any tax benefits. So basically that derives our answer here as to why we're sitting with a nil deferred tax asset that's being raised, because in essence they're saying there's no reasonable expectation that the company is going to make taxable income in the future, so therefore there is no need for them to inflate their assets in the current year by raising a deferred tax asset when they don't expect to have any profits against which they will utilize in future. So the economic benefits that this deferred tax asset is carrying is not going to materialize in future. And then they ask us the question, why is the deferred tax asset nil, even though the deferred tax asset is supposed to be 500,000 times 28%? So we've already done a brief discussion on that. And they say here the deferred tax asset cannot be recognized because there's no assurance that there will be enough profit in the future in order to use the deferred tax asset. So I really hope that you guys are understanding this principle and are understanding this concept, because I'm trying to break it down in its simplest form. But in essence, what they're saying is that even though your calculation, when you're looking at your calculation, you're landing at a temporary difference, but because the company does not expect that in future they will have sufficient taxable profit against which they can apply or they can utilize this asset against, they cannot recognize that deferred tax asset. Because what's going to happen is if they had to go and say 500,000 times 28%, they get to a figure, they take that figure and they recognize it in their balance sheet, they're in essence overstating the assets, because they're not going to have profits 5 years down the line in order for them to actually materialize and for them to actually utilize this asset, because this asset is basically saying that in future, when you're making profits and you have to pay tax, you can use this to decrease the amount of tax that you're going to pay. But if they're not expecting to make any taxable profit, then they're not going to be in a tax-paying position. So then it just deems this deferred tax asset that they currently have here, or that they're trying to currently recognize, as null and void. Okay, let's look at another example. It's the same example, but with the same set of facts, but we're just going to change our assumptions around a bit. Let's see what it says. The same set of facts that we learned in LE1, but assume the following for the purposes of this example. Deferred tax is provided for all temporary differences using the statement of financial position. There is assurance beyond reasonable doubt that there will be sufficient taxable profits in future to realize any tax benefits. Okay, so now they've gone same scenario, same amounts, but now they've gone and changed the wording relating to these future taxable profits, and now they're saying that it is actually probable, there's actually assurance beyond reasonable doubt that you'll be able to recognize this in future. So now let's see how this impacts our calculation and our conclusion. So still the same facts, and now we go and we calculate our tax at 28%, and we land at a deferred tax asset of 140,000 Rand. And now we're going to recognize this 140,000 Rand because it's now probable that in future they're going to have taxable income against which they can utilize this asset. So now we land at a concept called unused tax losses. Okay, unused tax losses. A deferred tax asset should be recognized for the carry forward of unused tax losses to the extent that it is probable that future taxable profit will be available against which the unused tax losses will be utilized. The unused tax losses result when the company has calculated a tax loss. Why do unused tax losses result into a deferred tax asset? Okay, so we're saying that now unused tax losses will only result when a company has calculated a tax loss. And then we've also posed the question is that why do unused tax losses result into a deferred tax asset? Okay, so we're going to unpack the answer to that in the following slides. And the best way for us to do that is by going through an example, go through it practically, understand, and then we'll go back and we can have a clearer understanding and a clearer vision as to why that is the case. Okay, so example 3. CA Limited have incorporated in the current year and the company... CA Limited have been incorporated in the current year and the company profit before tax for the period ended 31 December 2015 is 20,000 Rand. Included in the profit before tax is a depreciation of 10,000 Rand. The tax allowance for the year is 40,000 Rand. And of course, the tax rate is 28%. And they say deferred tax is provided on all temporary differences using the financial statement approach. There is assurance beyond reasonable doubt that there will be sufficient taxable profit in the future to realize any tax benefits. And the calculation required is for us to determine the deferred tax expense for the year ended 31 December 2015. Okay, deferred tax expense. And we're currently sitting with a profit before tax. So already we're given our tax allowance, we're given a depreciation figure, and we're told that it's probable that we can realize any tax benefits in future. So you're already thinking, I'm sitting at a profit before tax, which is an accounting concept. I've got tax allowances, so obviously there's going to be a couple of adjustments that are going to have to be made in order for us to be able to answer this required. Okay, let's understand and let's unpack what the example is requiring from us. In essence, the required is asking for a tax computation. Okay, you have to calculate taxable income or taxable loss by applying the tax rules because it is purely a tax calculation. Okay, the technique is to adjust all accounting entries and include all the tax entries, because remember when we covered in our first lecture, we did say that there's pure accounting concepts and then there's just pure concepts that we derive using just tax legislation. And in order for us to align the two, or to get to a common ground between the two, is for us to process a few adjustments. And that's exactly what this example is alluding to, and that is what this example is requiring us to do. And already you can see how, going back to lecture number 1, you sort of have that basic understanding of that there's actually an accounting, there's accounting concepts of how you get to your income tax, and then there's also your tax legislation, and as a result of the two, we have this inconsistency which we call deferred tax, and then obviously we need to process a couple of adjustments in order to align and to keep. I want to put this in marks, not exclamation marks, in inverted commas, to sort of keep the two happy and keep the two aligned. And let's see, for the purposes of this example, we will strictly do the tax calculation without drawing any distinction between non-deductible or taxable and temporary differences in order to demonstrate the principle. So basically, this is just a very, very basic example that's purely there just to highlight the principle. So let's see. Okay, so we're doing our tax computation, where we start with our profit before tax, because let me just actually pull up my pen. Okay, so here we have our profit before tax, which we would have arrived at, I want to say accounting. This pen is just not working. Okay, so everything above profit before tax, that is just us applying our pure accounting principles and our pure accounting understanding. And then we'd obviously have to adjust for our accounting entries, which is depreciation. Depreciation is not a tax concept, it's an accounting concept, so therefore we need to add it back. Because what we would have done in order for us to arrive at our profit before tax, we would have subtracted our depreciation expense, so it would have been a deduction. So now that we want to sort of work backwards in order for us to get to our taxable income or a taxable loss, we need to add back that depreciation so as to cancel it out, and saying that the taxman does not recognize what depreciation is, so we're going to need to take that depreciation amount out. And what we do bring into account instead is our tax allowances, which is basically calculated in terms of tax legislation. So therefore we will subtract our tax allowance. So we're sitting with our profit before tax of 20k, we add back our depreciation, so we're sitting with a 30k now. So in essence it's sitting with a 30k taxable income. And then from there we subtract our tax allowance of 40,000, which then lands us at a tax loss position of 10,000 rand. And because now we're sitting in a loss position, in a loss making position, we're obviously not we can't pay any income tax on a loss, so therefore we'll be sitting with a current tax expense of nil. So we're sitting with the loss of 10,000 rand, but we're going to have a current tax expense of nil. And now that we're sitting with this 10,000 rand loss in year number one, well, now this is year number one of losses, which is 2015, you will then see when we do another example how it sort of accumulates, and if they carry on making losses, how these losses accumulate, and then how having a deferred tax asset has an impact on these unused tax losses that are accumulating. Okay. Oh, sorry, that's done. Okay, so now let's do a quick recap. Remember, we don't pay tax on the tax loss, remember? But SARS allows you to utilize the unused tax losses against future taxable income in the future years of assessment. So basically, this is the principle that we've been trying to explain, is saying that, okay, you've made a loss in the current year. Obviously, there's no current tax expense that you can recognize, but you're now sitting with a tax loss. And then SARS is now saying that you can keep carrying these tax losses forward up until a point where you actually start making taxable income in the future, and you can then utilize these losses against that future income. And we'll see that more clearly as we do an example. Unused tax losses result into deferred tax asset given that certain conditions are satisfied. So if you go back here, and we're currently sitting with this tax loss of 10,000 rand, and in the following year we make a 20,000 rand tax loss, so then we'll be sitting with an accumulated tax loss of 30,000 rand, and we're saying that this deferred tax loss actually results in a deferred tax asset. So then we will calculate a deferred tax asset on that 30,000 rand, which is our economic benefit that we will apply against our future taxable income. Okay, so unused tax losses result into deferred tax asset given that certain conditions are satisfied. And we did cover the conditions in the earlier slides, and one of them was the fact that it is probable that the company will be making taxable income in the future. And we use the tax table to calculate the deferred tax expense, and we apply the table approach by using the following steps. Firstly, we need to identify whether it's an asset or it's a liability, and we need to sort of ascertain in which rule we need to apply. Do we apply rule 1 or rule 2 for the assets? Are we saying that our carrying amount, is my carrying amount a liability, and is it greater than my tax base, or is my carrying amount an asset and is it less than my tax base? So that's what they basically mean when we're saying that we need to apply either rule 1 or rule 2 for assets. And an important thing that we need to remember is that in accounting we don't record tax losses in our accounting records. However, tax loss satisfies the definition of an asset because the future economic benefits that will flow to the entity as a result of the tax reductions, and therefore reduces the tax liability. So therefore, this again builds on the first lecture that you would have had on the conceptual framework and understanding what is an asset and how you recognize the asset. And I actually, as a quick exercise, I encourage you to go back to refresh your slides on the conceptual framework and apply the definition of a deferred tax asset. Apply the conceptual framework to the definition of a deferred tax asset, to the definition of a deferred tax liability, and just apply your knowledge and your understanding and see that and sort of like conclude whether you can justify that it can be recognized as such, and we can therefore conclude that a tax loss is an asset. So yeah, so I'll just make a note here. I'll just make a note here that there's a task. Yo, this pen, but like, you get it, that's a task that I want you guys to please complete for me. And excuse my writing. Okay, so we have another example. We are now going to calculate our deferred tax asset because we've already now concluded that our tax loss is actually going to that our tax loss is an asset, and the fact that it is going to result in a deferred tax liability. And what we can see just by looking at this example is that in this example we're going to apply rule 2 of our 2 rules in determining our deferred tax asset. And rule 2 said that when your carrying amount of your asset is less than your tax base, and that's how you land at a deferred tax asset. And you will see here we have our assessed losses, we have a carrying amount of 0, and we have a tax base of 10,000 Rand. Carrying amount is 0 because we arrived at this tax loss. I just want to go to the previous slide, and I want you to understand why we are carrying amount is 0. Carrying amount is 0 because we did away with accounting when we were doing this tax computation. We were saying that this 10,000 Rand, we're saying that this 10,000 Rand has been derived at using our tax legislation. So we've applied tax principles. Hence, this tax loss is why it is now sitting as a tax base, and why our carrying amount is sitting at 0. And if we apply rule number 2, we see our carrying amount is 0. We're sitting with the tax base, which we derived through our tax computation, where we applied our tax legislation, and we arrived at 10,000 Rand, which resulted in a temporary difference of 10,000 Rand, and we calculate 28% of that. And that is how we land at a deferred tax asset of 2,800 Rand. Okay, and so now we're going to sit. So we're sitting with a balance of 2,800. That's my deferred tax asset. And here we have to raise obviously a journal for it, because now we're going to raise this asset we're going to raise this asset on our books at the end of the year. And then we're going to have a corresponding expense of 2,000 Rand. And what we're saying is that we're in essence raising a provision. The provision has been made for a deferred tax expense. So we're going to debit our deferred tax asset and we're going to credit our deferred tax expense. And in future, when we have our realizable profits against which we apply this deferred tax asset, that is when we actually credit our deferred tax asset, because we're saying now we're utilizing our deferred tax asset, and then we will then debit our expense. But we can obviously unpack that further as we come across more examples, or if you guys have a different view or questions on that, we can, I'm obviously open to have a discussion on that. Okay, sure, that was an entire half an hour just on assessed losses. So I think the rest of the material is going to be a bit more theoretical with a few examples. So I am going to go into it in some detail just so you have a basic understanding of it. But of course, please make use of the platforms that are available. I'm available on email, I'm available on phone call, on WhatsApp. Obviously we're going to arrange time for us to really delve into some of the concepts that you may not be grasping, because I do obviously understand that I've got a set amount of time to give this lecture, and I may not go into as much detail as you would require. Okay, so now what we're going to look at measurement. Okay, deferred tax asset liabilities shall be measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled, based on the tax rates that have been enacted. So basically what that is saying is that if in 2020 I do my calculation, but in the midst of me doing my calculation, as it happened this week, there was the budget speech. Had Tito Mbeweni announced a change in the tax rate that was going to be applicable to a future period, when I do my calculation, I need to take that information into account. So basically that's what it means when it says that the tax rates, you need to apply the tax rates that are expected to apply to the period when that asset is actually going to be realized or the liability is going to be settled. The measurement of deferred tax liabilities and deferred tax assets shall reflect the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover or settle the carrying amounts of its assets and liabilities. The manner in which the entity intend to recover or settle the carrying amount of the assets or liabilities will determine the tax consequences. If the entity intends to recover the carrying amounts of the assets or liabilities through sales, the tax consequences should reflect sale. Think about IFRS 5 and investment properties held at fair value. Okay, let's move on to part 3. So measurement is very much theoretical, and the basis of it, the core thing that the point that's just coming across here is that if you have an expectation that in future this is the rate that will be applied. So if as at the time you're busy doing your calculation and knowledge comes into being that, hey, listen, the tax rate is going to increase to 30%, then obviously you need to take that into account, because if they're saying that this asset is going to be realized next year and you know the tax rate is going up next year, you need to utilize that rate. Okay. And we said that the measurement of deferred tax liabilities and deferred taxes shall reflect the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover or settle. So measurement is very much saying that, if I break it down in its simplest form, it's saying it's forward thinking. Look to what's happening, and if you have an expectation that there are going to be changes, you need to take that into account. Okay, so presentation and disclosure. The basic principle of it is that you can net off deferred tax assets and deferred tax liabilities only if they relate to income taxes levied by the same taxation authority. So if it's from SARS on SARS, if it's a deferred tax asset against a deferred tax liability, then in essence we're saying that yes, that is possible. You can show that as a net and you can net it off. If the above requirements are satisfied, you can net off the deferred tax assets or the deferred tax liabilities. Okay. Is a deferred tax assets or liabilities a non-current asset or liability or current asset or liability in the statement of financial position? Okay, so that's a question resulting in your disclosure. It's asking you, would you disclose a deferred tax asset as a current asset or as a non-current asset? I do think that's a question for you guys to answer, and I would appreciate it if you discussed it among yourselves. And I think this is what we can also engage on WhatsApp, or maybe we can set up a meeting and we can all just sit and we can engage that and actually have a proper discussion on it together, so that I can understand your views and also share my point on that. So the income tax expense or should relating to the net profit or loss should be presented on the face of the statement of profit of loss and other comprehensive income. So yeah, that is some theory that you can read. The major components of an income tax expense or income should be disclosed separately. That's very important. And the components of income tax expenses or income tax income include the following. So you will see that if you've ever had a look at a complete set of financial statements and you go to your income tax note, you will see that your income tax, even though it's presented as a single line item on the face of your statement of comprehensive income, but there actually is a corresponding note to it that actually gives a proper breakdown of everything that relates to that amount. And it includes, but it's not limited to, the following. It includes your current tax expenses, any adjustments recognized in the period for current tax of prior periods. So if in the prior period something was possibly omitted or something had to be added, which now then has resulted in an adjustment having to be made, then we would obviously include that in the note. Any amount of deferred tax expenses of income relating to the origination or reversals, and the amount of deferred tax expenses or income relating to changes in tax rates or enactment of new taxes. So like I said, tax future thinking, forward thinking, you've done your calculation, news comes out that, hey, this tax rate is actually going to change, then obviously an adjustment as a result of a tax rate change arises, and that's obviously an adjustment that you need to disclose, and the amount of income tax relating to each component of other comprehensive income. And an explanation of the relationship between tax expenses or tax income and accounting profit in either or both of the following. So it needs to be disclosed as a round amount as well as the percentages. Okay, so let us do a quick example. Okay, CAPTY Limited is about to finalize the financial statements for the year ended 31 December 2017 and have presented you with the following transactions. Okay, they have income of 10K, they have salaries, and then they have expenses, which are their salaries, their water, and their depreciation. Okay, so we have 3,000 Rand in expenses. And then we also, then that results in an accounting profit of 7,000 Rand. And then we have a tax allowance of 1,700 Rand. And this now takes us back to applying our principles that we learned in the earlier slides. It says here, disclose the impact of the above financial statements for the year ended 31 December 2017, and only major tax expenses should be taken into consideration. Major tax expenses. So we already know salaries, wouldn't consider that to be major. Water, electricity, wouldn't be considered to be major, purely for the reason that SARS and the company, water is water, electricity is electricity, salaries are salaries. There's no two ways about it. Whereas with depreciation, there's a level of judgment. There's different ways of calculating it, and also considering the fact that there's a specific standard that governs how depreciation should be calculated, and SARS has their own tax rules that govern how allowances and deductions on assets should be derived at. So therefore, for that reason, we would consider depreciation to be a major expense that needs to be taken into account. Okay, and then we obviously do our quick current tax computation as we did previously. We start with our accounting profit of 7,000 Rand, which we landed at. We add back our depreciation because we're saying that now we're doing a purely tax calculation. We're only looking at tax rules, and Taxman does not recognize depreciation, and therefore we need to add it back to, in essence, eliminate the previous deduction that we made. So we add it back, and then we were given a tax allowance of 1,700, which we subtract, and we land at a taxable income of 6,800 Rand, and obviously we calculate our tax at 28% because we do have a taxable income, and therefore we can recognize a tax expense of 1,904. So that's going to be our tax expense. And then you say, what would you expect to see as a tax expense? You would have initially expected to see the tax expense at 1,960 based on the accounting profit of 7,000 Rand. So when you do your income statement and you do your balance sheet, you would have expected to say, okay, I've arrived now at my profit before tax of 7,000 Rand, and you would have said that times 28%, and that's how you would have almost landed at your taxable income. But now, because we're doing a pure tax computation, we say no, actually that is not the case. We've made some tax adjustments, so therefore that also needs to be taken into account